Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to a new year of opportunities in the market and, of course, risks. You cannot have one without the other, I'm afraid. The underpin of finance as we know it is that more risk should equal more reward. If that balance is out, then something is wrong. Either there's a lovely opportunity on the table or a terrible one, depending on the direction in which things have moved out of balance. In theory, developed markets should be less risky than emerging markets. This doesn't mean, though, that every sector in a developed market is a safer bet than every sector in emerging markets. For example, the automotive sector in Germany looks riskier right now than almost any alternative I can think of in South Africa. I really wouldn't go anywhere near it. And it gets really painful when developed markets move up the risk curve because they don't tend to offer additional reward to make up for it. And the only outcome there is that asset prices must fall. All that happens is that investors get hurt. Welcome to risk and reward. Further along the risk spectrum, we get to frontier markets. This is where things get particularly wild. These are underdeveloped economies where even basic human rights are generally a luxury for far too many people. Much of the investment that flows into these countries has a social angle to it, which means tapping into typically European and American funds that include social metrics in their investment decision rather than purely financial metrics. This is an area of finance known as impact investing, and it is very interesting indeed, as it funds many important projects in areas like food security, for example, or healthcare. The sectors in these markets that have attracted investment with a purely for-profit motive typically include things like telecoms, mining, and consumer products. In my advisory career some years ago, I had the great opportunity to travel to Kenya as part of a capital raising mandate for an FMCG platform business. It was fascinating to go to the villages and see what was required to try and successfully get products to people who have GPS coordinates rather than a street address. I was sad to note that in early 2024, the company in question failed to raise funding and went into administration. Because, here's the thing, Africa is hard. In fact, it's ridiculously hard. The politics are extremely complicated to navigate, as borders are often a random colonial hangover rather than a reflection of the cultures of the people within those borders. We've seen everything from genocidal catastrophes through to general election violence, and that's when elections actually happen, which is not a guarantee. Economically, there are far too many countries that are dependent on single commodities, which leaves them horribly exposed to macroeconomic volatility and big moves in their currencies. Then, on top of all of this, there are governments that seem to thrive on kicking corporates when they are down, either through large tax assessments that have more fictional quality than half of your local bookstore, or through mechanisms like what we've just seen in Zambia, where an export tax has been reintroduced on emeralds at the worst possible time. Good luck, shareholders in gem fields. A lot of what you see as success in inverted commas in Africa is often just a can being kicked down the road through various rounds of capital raising activities with venture capitalists. Very, very few of the large platform businesses are actually profitable. Instead, they rely on finding professional investors who have raised money off the back of an emerging markets mandate and some very pretty charts about Africa, along with the obligatory assortment of pictures of lions. They then need to deploy that capital to justify their ongoing existence to their developed market investors. So even suboptimal projects can often get a slice of the pie, and some allocation at least, so that venture capitalists can tell a great story about how they participated in the raise and got onto the register. Now, goodness knows there are some decent stories to have come out of venture capital backgrounds. There really are. But much of it, honestly, belongs in the same WhatsApp group as most Ponzi schemes. Scaling something for the sake of scale is not the same as building something to be profitable, and far too many venture capital-backed firms are little more than an attempt to grow just enough to raise even more funding. Never mind become profitable. That is not a sustainable way to do business. So what about commodities? Surely that's a good story in Africa. Well, it can work, provided local government is adequately incentivized, often formally through shareholding, and sometimes, let's just say informally, I like to think that listed companies don't get too involved in that, but unfortunately, corruption is a major feature of frontier markets. It's even a feature of emerging markets, let's not kid ourselves, ours included, with occasional shockers coming out of developed markets as well. Humans everywhere in the world are self-interested creatures, and not all of them have great morals. I think the difference in frontier markets is that there are just fewer safeguards in place, and those in power often rule with an iron fist. You don't necessarily have a great legal system or freedom of press, so they can get away with far more things more of the time. If anyone has cracked the Africa conundrum, it's probably China. They figured out a long time ago that if you just swap infrastructure for commodities, you can strike a deal. There are no sheep in that equation, only wolves dancing a delicate game. It seems to work quite well for all involved, although there will be lots of different views about how ethical all of that really is. The point I make is that the risks in Africa are immense. But what about the rewards? Go on, try and think of a single great story to come out of Africa in the past decade for a South African corporate listed on the JSE. Name one that has really made it work on the continent on a consistent, through-the-cycle basis, not just in one particular good year. There are some sectors that might have managed it, mainly I think in financial services and banking. There have also been some big whoopsies along the way in those sectors. As for telecoms, it's been a complete disaster. MTN's share price has performed so poorly that they even had to restructure their BEE deal just to avoid it maturing at close to worthless levels, and you can largely thank the African exposure for that. Vodacom, seemingly inspired by this performance, has taken on risk in Egypt and is now experiencing the same forex pains. Have you noticed how the recent trend among listed corporates is to run away from the rest of Africa rather than towards it? Shoprite realized that things were not going to go so well, so they got out of that exposure to focus on their home market and look at the benefits from that. The African adventures literally nearly killed Nampak, with much of that survival plan being based on an exit from Africa. Property funds have also been pulling back from the continent. 15 years ago, the rest of Africa was a key feature of practically every corporate business plan, every results presentation, every single strategy day. Investors demanded a strategy around Africa. Today, you will hardly see it get even a mention unless you are looking at a genuine African powerhouse like Standard Bank. And even there, some years are much better than others. It's not consistent. There are at least some strong niche players that have a good story to tell there, with clever models like CA Sales Holdings, for example, tapping into that FMCG space, or Advotech with high-margin schools in Africa targeting expats and wealthier locals. But these are the exception. The majority of sectors and countries in the rest of Africa, I'm afraid, have become uninvestable. The rewards are not worth the risks. It's a sad situation, especially for people on the ground who desperately need economic upliftment, but it is a reality. And unless China can find a way to grow at high rates again, despite a Make America Great Again government on the other side of the world, I cannot really see the situation improving. Africa is going to stay reliant on impact investing, and those with a purely for-profit motive are going to struggle to justify exposure and investment. Now, the beauty of capital is that it can flow to the most appealing places fairly easily. It doesn't have to get stuck somewhere. Just because the rest of Africa has proven to be a bleak story for most South African corporates doesn't mean that there aren't options elsewhere. Within the BRICS grouping, Russia is a global pariah, so there's really nothing to discuss there. China is a completely different economy and market to India, and that's worth talking about for a moment. The former is based mainly on manufacturing, whereas India is far more of a services economy. We have immense look-through exposure to China due to our commodity sector, as well, of course, as Naspers and Prosus with Tencent. And the disaster at ArcelorMittal has once again illustrated just how important China is to the local commodities market and what it can all mean for us when China isn't necessarily doing well. As for India, there are a few companies on the JSE that have invested there and have done so quite successfully, like Sanlam, for example. It's not surprising to see a financial services slant in the Indian exposure on the JSE because that reflects the underlying nature of the Indian economy and what the opportunities look like there. But what about Brazil? We find pretty decent economic growth there in 2024 that was better than people anticipated at the start of the year. Unemployment in Brazil was just 6% at the end of 2024, well, November 2024, the latest available stats, and that is a record low. Of course, Brazil has its own risks, but why do we see so few South African corporates making the move into South America? Pepkor has done it with Avenida, which I think was a brave and interesting transaction, and I'm very excited to see how that all plays out over coming years. Naspers and Prosus are now doing it with Despegar, leaning on the expertise of CEO Fabrizio Bluisi and his Brazilian background. But what other opportunities might be found on that continent? And are our corporates going to look there anytime soon with the benefit of the lessons learned in the rest of Africa? It's not that hard to find stuff. This is why the investment banking industry exists, because advisors connect capital with opportunities. If boardrooms become serious about looking in South America, they will find stuff. And I just can't help but think that more executives on that SAA direct flight to Sao Paulo might be a good thing for South African corporates. They may find some good stuff there. Of course, I would love to get your thoughts on whether South America represents an opportunity that South African corporates should be seriously considering. Or would you prefer to see them continuing to try and figure it out in the rest of Africa? Do you believe the rest of Africa is investable? Leave your thoughts in the comments on this podcast. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.